Yeah, we've long argued for several years that on a relative valuation basis, you want to be short the major banks' equity, long regional banks. For the following reasons, we've argued that the major banks would have to undergo a significant recapitalisation and deleveraging of their balance sheet, which would crush returns on equity towards their cost of equity. We've seen that play out. We've called for several years, ROEs converging towards 11 to 12%. And we're seeing that in the reports and some of the recent results of the major banks. On the other hand, the regional banks, particularly Suncorp and Bendigo, will be likely by the end of this year classified as internal ratings-based banks or advanced banks that will, all else being equal, put them on similar capital leverage and risk weight levels to the major banks in the housing market. So Suncorp and Bendigo, and probably in time BOQ, basically have an opportunity for the first time to compete on a level capital leverage and ROE playing field with the majors in the resi mortgage market, which is obviously their biggest market, roughly 60% of assets. So we see ROE, so within regional banks, capital on a risk-weighted basis and should be falling slightly, or certainly not increasing, and leverage will be not declining, possibly increasing. And we'd be looking for an improvement in ROEs. So generally we've been looking for heightened competition in the resi mortgage market particularly to really place additional pressure on those major bank ROEs. And we've been looking for opportunities for non-major banks, their rivals, to expand ROEs through improved capital leverage and risk weights. Overall, we expect the major banks' valuations on a price to book value basis to converge around 1 to 1.5 times. On that basis, we find that CBA and Westpac are still very expensive. Ironically, they're the banks that are most exposed to the most commoditised and I think competitively vulnerable market, namely the resi mortgage market. In the past, the majors also had an advantage on their cost of capital, their fundraising, but we think that's dissipating over time, particularly because with the advent of the government guarantee of deposits, there's less price discrimination amongst depositors between banks because all banks get the benefit of that government guarantee. And ironically, if you're a regional bank that raises, say, 60 to 80% of your money, if not more, from deposits, you're going to get a much closer cost of capital to the majors than you would in the wholesale bond markets. The majors are still getting circa 30% of their money from wholesale bond markets where the cost of funding is much higher than deposits currently, and there's much more price discrimination between banks.